biggest macroeconomic features that might interest investors will both come from overseas this week. First, we have two indicators of economic sentiment in Europe, the German IFO survey and the Belgian Corb Synthetique on Monday the 24th of September. While we have been focusing on Brexit on this side of the channel, this issue is exercising other members of the European Union too, where a row with Hungary over rules and regulations and concerns over the Italian budget due in October have also been causing concern, not to mention, of course, worries over President Trump's talk of tariffs on trade. The German survey wobbled in the spring and summer, but tried to forge a recovery in August, so economists and analysts will be looking to see if that uptrend has been maintained. July's score, for the record, was 103.8. As for the Corb or synthetic curve, we must always be wary of confusing correlation and causation and accept that past is no guarantee for the future. But for whatever reason, the views of 6,000 Belgian industrialists do seem to have been a pretty fair guide to the European benchmark index, the Stoxx Europe 600. Like the IFO, the Corb lost momentum in spring and summer, but it rallied to minus 0.3 in August, so again, let's see if that becomes more of an encouraging trend. The other huge macro item of the week is the latest interest rate decision from the US Federal Reserve on Wednesday the 26th of September. Chair Jay Powell is expected to announce the third 1/4 point interest rate hike of this year to 2.25% and to lay the groundwork for another increase to 2.5% in December. Watch out for that and any changes to the Fed's so-called dot plot guidance for 2019, which currently points to 3 more rate rises of 0.25% each to 3.25% by next year end. It's also worth keeping an eye out for any comments on the rate at which the US Central Bank continues to withdraw quantitative easing, or QE. That is due to go up to roughly $50 billion a month from October, or $600 billion a year, a big number as it represents a seventh of the Fed's total $4.2 trillion in assets. President Trump may or may not be draining the swamp, but the Fed is certainly draining liquidity from the markets. On the company front, we have 4 FTSE 100 firms set to publish results or trading statements, with a number of mid and small caps doing the same. They include utility Pennon and house builder MG Gleeson on Monday the 24th of September. We've also got 2 more utilities, SSE and United Utilities, on the 25th, although SSE has already coughed up a profit warning. Retailer SSP and support firm Mighty on the 26th, Halma and travel insurance group Saga on the 27th, and hybrid estate agent Purple Bricks on Friday the 28th. But the stock that's probably most likely to cause a bit of a fuss this week is retailer Next when it released its first half results on Tuesday the 25th of September. After a torrid 2017 characterised by several profit warnings, Next has worked its way back into investors' favour in 2018, helped by the absence of profit warnings, healthy dividend payments and encouraging guidance for the year to January 2019. This financial year's got off to a good start, with May's first quarter trading statement better than expected. Full-year like-for-like sales rose by 6% as a result of Chief Executive Lord Simon Wolfson's raised profit and earnings per share guidance for the year. The second quarter saw full price sales growth ease back to 2.8%, according to August's trading statement, but with no change to forecasts. As a result, Next is now looking for the following performance for the full year, and these will all be useful benchmarks for these first half numbers. In terms of like-for-like full price sales, Next stuck to its forecast of 2.2% growth for the whole year, even though it managed to beat that in the first and second quarter. For pre-tax profit, Next is looking to earn £717 million in the whole year, up from prior guidance of £705 million. Although that does still mean a very slight drop from £726 million last year, the third straight year-on-year decline. And finally, watch out for an update on the share buyback programme. The company plans to return £300 million to shareholders via buybacks this year. Lord Wolfson has made no mention of a special dividend compared to last year's 180 pence per share distribution, and analysts currently expect the ordinary full-year payment to come in unchanged at 158 pence a share. The split last year, as we can see in the final graphic, was a 53 pence interim payout and 105 pence final. That's it from me. Thank you very much for watching, and I look forward to seeing you next time.